In this video, I'm going to show you a trading strategy using the Exponential Moving Average and the 10-in-1 indicator, which will help you making profits. In order to begin, let's go to tradingview.com to start setting up the time frame. This strategy works on very large frames, such as 1 week and 1 month, but in this video, we will use it on a 4-hour time frame. Let's move on to the indicators, which are, as I previously said, the Exponential Moving Average and the 10-in-1 indicator. Now we'll open the indicator settings to activate the 3 moving averages, as seen above. However, make sure you've selected the Exponential Moving Average, also known as the EMA indicator. The length of the first moving average will be 200, the length of the second will be 20, and the length of the final moving average will be 5, despite the fact that it was supposed to be 10, but that would be more complicated. You can select the colors you want from this menu, and these are the crucial parameters for this indicator, which is the major indicator in this strategy.
As we can see here, the first criteria in this strategy is that the candles has to reach the 200 moving average from bottom to top, and once this criteria is reached, we will begin looking for entry-level positions.
Sometimes we witness a fake breakout or short-term movement, which we will discuss later in the video, so make sure to watch to the end. But let us look at the other requirements. So, after the breakout, we should notice that the moving average 5, which is in green, is higher than the moving average 20, which is in red. This means that the lines should be arranged in the following order, and these are the only requirements for the moving average indicator. Let's move on to the second part, which is the circumstances for candle movement. To begin, we must note that the candles are above the 2 moving averages of 5 and 20. Then we must check to see if the body of the candles or their wicks touch one of these 2 moving averages, implying that the lower section of the candle should be touching either the green or red line. Third, after we have 1 or more candles touching these lines, we need to notice that one of the candles has moved away from the moving average, and this candle here will be the target candle. There will be further conditions after identifying the target candle. The first requirement is that the next candle has closed at a lower price level than the target candle, indicating that it is shorter. The second criteria is that we notice other candles that have hit one of the moving average lines and have closed lower than the target candle. When this condition is met, we will create a horizontal line above the target candle and just wait for it to be broken. These were the main prerequisites for this technique. However, when trading, we may experience various more problems that are not given in this simple explanation. Let's try to visualize this on the chart and look at these problems step by step. As you can see, I chose a suitable section of the chart to begin describing the method, and then we'll go on to more complex examples. If you were trading here, the first thing we would do is watch for the 200 EMA to be broken. Then we can see that the moving average crossed here at this candle, but we must wait till we observe that the green and red lines have also crossed the 200 average. We must now witness that the candles have begun to touch the green line, and even touching the red line would be acceptable. As we can see, the candles are touching the green line, which is a good sign. All we want now is to see one of the next candles close above the green line without touching it, and it is ideal to have a wick from above. Here we observe a candle that is distant from the green line and is extremely nice, so it will be the target candle. However, the candles that follow it should be shorter than it and should hit the green or red line. We can see that, following the target candle, a shorter candle appeared, also touching the green line, so we will prepare entry, stop loss, and take profit orders. The entry will be just above the target candle, and the stop loss will be at the moving average line 20, which is the red line. When it comes to taking profits, it will be double the stop loss, implying a risk-reward ratio of 1 to 2. As we can see, the candles have begun to fall, but we have not yet reached the entry level. At this level of the candle, the entry order has been completed, and all that remains is to wait for the first target to be reached. During this time, the target has been reached at this candle. While you waited for the target to be reached, there were some other opportunities, which mean that if this one was missed, you could have placed another order over other candles. In fact, there are several opportunities, but they must be pursued with caution and without haste. Let's go on to another example of this strategy. Here, a candle appeared that agreed with the conditions, and all we have to do now is wait for the candles that follow it to confirm the signal. As you can see, the second candle was shorter than it and also touched the green line. Consequently, we will place an entry order above the wick of the target candle. Then we'll wait for the candles to reach the entry point before proceeding. The stop loss will be set at the 20-day moving average, and the take profit will be double the risk. The buy order has now been activated at this position in the candle, and the target has also been met at this level. We identify a candle that meets all of the criteria, as well as the candle that follows it, which will be the target candle, and we will place the entry order above it. As previously said, stop losses at the red line, and profit will be calculated by multiplying the value by 2. Now we'll wait for the price to reach the entry level, which is just above the target candle. We appear to have lost, and the price appears to have reached the stop loss as well. However, this didn't happen and we did not suffer any losses because the price didn't reach the entry level. And this is one of the best aspects of this strategy. When the price reaches the level of the target candles, it will usually continue to rise because the target candles are considered resistance candles, especially those with an upper wick, and if their upper level is broken, the price will rise. Because a red candle has appeared below the green and red moving averages, this signal has been consumed and must be cancelled. Even if the following two candles have risen and reached the entrance level, they must be cancelled and another target candle must be waited for. To eliminate all of these repercussions and obtain fewer and more reliable signals, we shall employ another indicator, the MACD indicator. Now go to the settings, click the input section, and adjust the time frame to 1 day. When the blue signal line is below the red line, we will conclude that we are in a downtrend and will not enter any buying positions according to the MACD indicator. This signifies that we have eliminated the complex signals that were before present. However, when the blue line crosses the red line, as it does here, we will start looking for long positions in accordance with the technique we have explained. I'll now give you some excellent tips that I personally employ when trading with this method. First, always try to find the target candles, and it doesn't matter if they're red or green, the key thing is that they have an upper wick. Remember that the further you are from the green line, the better. If you want to see one of the trading strategies I use when day trading, check this video right here, because this strategy works great on the 5-minute time frame. I'll see you guys next time.